The central banks, together with treasuries or chancelleries, stopped there being a massive recession as a result of COVID. You could easily have seen economies falling over because of COVID. We stopped that happen. When do you take the brakes off? How do you take the brakes off without causing untoward effects? It's easy to look backwards and say rates should have gone up earlier to choke off inflation. That's very easy to do. It's very difficult at the time to think of that, and having just gone through a period, the most extraordinary period, I guess, since the Second World War, when economies could have fallen over, you've got to give the central banks a bit of slack. I mean, it's just unheralded sort of times, and retrospect, I think they've negotiated it reasonably well. As I say, maybe they should have put rates up earlier to choke off inflation, but it's very easy for us to say that now.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Welcome to this week's podcast, during which I get brought up to speed with European and UK economics by my guest, Keith Hiscock. Keith is Chief Executive Officer at Hardman Co in London. Welcome, Keith.
Thank you. Good to join you.
Keith, 2023 was a year in which central banks globally took upon the fight against inflation by tightening monetary policy. Tell us about the European economy. Where does it sit today?
Well, I think both in Europe and the UK, we have seen the peak in rates, and I think we're going to see a gradual reduction. Obviously, there's a great debate about the speed of that reduction. One's got to bear in mind that the rate increases have already happened. Take some time to filter through to the economy as a whole. If you've got a fixed mortgage, for example, or if you've got a car deal, you won't see the impact of that perhaps for another year or so. Obviously, policymakers are aware of that. So I think we're going to see rates coming down gradually. I'll put some caveats in a second. And what we're seeing is a gradual recovery in GDP. Now, I think both in Europe and in the UK, there were many commentators who expected there to be a full-blown recession. And that hasn't happened, and they've been blindsided by that. But equally, I think the feeling is that the recovery is going to be really quite slow. So if you look at the forecast for Europe, so last year, 2023, growth in GDP was about 0.6% in the euro area. This year, the forecasts are looking like 0.8, and then 1.5 in 25 and 26. Now, so there are some caveats, and there are some fairly obvious caveats, such as what happens in the Red Sea, whether that might delay trade, whether the conflict in the Middle East might expand and what the effects of that could be, what might happen in Ukraine. So there are all those kind of political, economic caveats that might change regulators' attitude, in particular to squeezing inflation out of the system. So I think we're seeing a gradual recovery. There are some particular issues in Europe. So the two biggest economies are the ones that are probably struggling most, France and Germany. And I think in the case of Germany, there's a big worry now about the impact of Chinese car manufacturers in the EV space on their economies. And so you're starting to see the manufacturers put pressure on the politicians to delay the date when you can't sell petrol or diesel cars, to think about more tariffs on Chinese cars, all that sort of thing. I think they're beginning to wake up to the threat to their to one of their biggest industries out there. So those are the kind of the broad headwinds out there at the moment.
It's interesting, that growth is actually expected to be faster this year, despite tighter monetary policy. Has the European Central Bank done a good job in controlling inflation to date, do you think?
Well, yes, it has, although quite a lot of it is out of its control, obviously. Commodity prices, oil prices, it doesn't have any influence over at all. But, you're now seeing inflation. So inflation in the Eurozone in November last year was 2.4%. It'll tick up a little bit. It's expected 2.9% in December, but they should meet the 2% target by 2025. It's not a dissimilar story in the UK. So they have done a good job. I mean, I think there was a worry that very tight labour markets were and pressures to compensate for inflation from workforces, particularly unionised workforces, to push up rates would make it very difficult to get inflation under control. They seem to have done a good job against that background.
But you're not talking about very big changes in inflation. I always remember this from European economics. Yeah, certainly the Bundesbank and now the European Central Bank were very hawkish about inflation and where it's at. But I mean, 2.4% relative to a 2% target, it's kind of nearly there, right? So what does the projection for monetary policy look like? I mean, if they start reducing rates, have they got much further to come down? And will it stimulate the economy?
Well, just as I said before, putting rates up has, to some extent, a delayed impact on demand. Bringing rates down equally has a delayed impact on demand. So I think we are going to see rates coming down slowly in the European economy. I remember, inflation's been, well, look at the UK, it was 11% in 2002. It's slightly behind where Europe is, but it has come down substantially. You might argue, well, it's not of the doing of the authorities because we've gone through a peak in commodity prices and it's that's really brought it down. So I don't think they can take all the credit for it.
Well, let's turn to the UK economy. What's the outlook there? I mean, are we going to see faster or slower growth relative to Europe?
Slower growth, very clearly. I'll put some caveats in as always. So as I said, we didn't see the recession that people thought we were going to have. That was a surprise. But equally, the forecasts, the Bank of England's own forecasts are there'll be no growth in 2024. It'll be 0.5% in 2025, 0.8% in 26, and 1.5% by 27. One of the big debates I think going on amongst economists is, is this the new environment, and are we never going to get back to the traditional 2.5% long-term growth rate that we had in the 60s and 70s, etc.? Are we going to be sort of not much above zero? So we don't know the answer to that yet, but I mean, certainly forecasts will be going up. So if you look at the UK, the forecast of a few months ago for 2025 was that GDP wouldn't change in 2025. We're now forecasting a 0.5% increase. So it's sort of going in the right direction, but we're still not being terribly confident that we're going to see growth in the UK. So in terms of growth, it's been slow. In terms of inflation's come down very substantially like Europe. It peaked out at 11% in 2022. Back in December, it was 4%. So it's still higher than in Europe, but it's forecast to get down to 2% by maybe the second quarter of the current year. So there's that going on. Bank rates, 5.25% at the moment is the minimum lending rate in the UK. That is going to start to fall by the year end. At the moment, I think the consensus it'll be down to 3.9% by the year end. The caveats around that, obviously the same caveats for the euro in terms of what's going on in the Middle East, what's going on in the Ukraine, but there's an extra caveat in the UK, which is that we have an election. We have to have a general election by January of 2025. It probably won't be that late. It's all most likely to be in the autumn of this year. That might cause businesses, consumers to reconsider what their plans are for the year. So far, I think you could say what the opposition is saying at the moment. The polls are showing very clearly that the greatest likelihood is that the Labour Party will get elected with a majority. They're setting out their policies now, and those policies seem to be essentially, well, we're going to keep them exactly the same on the financial side as the Conservatives. So maybe one shouldn't worry, but it's obviously a bit of a cloud that affects corporate sentiment and consumer sentiment.
Now, let's turn to the stock market, or the outlook for the stock market. Last year, stocks in Europe underperformed US stocks quite significantly, but they had a good year. I mean, it was just a very good year for US stocks. Will 2024 be better for EU or US markets, in your opinion?
Well, I think the big decision you have to make is, what do you think is going to happen to tech? Because if you think tech stocks are going to perform well, you'll want to buy the US, not Europe. If you don't think that, then you can start to look at Europe. We're seeing very clearly the US economy returning to a remarkable growth rate, which, as I've just set out, I don't think Europe or the UK is going to experience. So there's quite a lot in favour of the US. However, there are some other things going on, which is part of it. So, the European economy and the UK economy is much more an international economy than the US economy. A lot of GDP is from trade overseas for Europe and the UK in a way that it isn't for the US. So the performance of markets like China is more important to Europe than it is to the US. There's one sort of slightly countervailing thing I think I put in there, which is certainly in the UK. The UK has been a particularly poorly performing stock market, but we're starting to see quite a lot of takeovers. There's quite a lot of buying of interesting assets by private equity or industrial buyers, or what seem to be fairly distressed prices. So I think that might start to lift people. If investors in the UK think that actually these valuations are obviously too low, because we're seeing them go out to foreigners, they might start to reassess on that basis.
One final question, Keith. There's been a remarkable lack of volatility in the currency markets. I think sterling against the dollar and euro against the dollar has really been in a very, very tight range for a couple of years now. What do you make of that?
Well, I think that the main reason for that is probably what's happening on interest rates. And interest rates have certainly supported the European currencies. If we were suddenly to see a forecast that rates are going to come down much more sharply, I think that would have some impact on the currencies, and the European currencies, the pound would weaken against others. But at the moment, that's one of the supports for them.
And of course, reducing interest rates would be potentially better for the economies. But again, I suppose it really matters why they want to cut interest rates that sharply if you're heading for that recession, that elusive recession, I think, seems to be one of the big stories here.
Yeah, the recession that never happened. I mean, it's been a really difficult time to be a central banker. It's probably never a good time to be a central banker, let's be honest. But they stopped, the central banks together with treasuries or chancelleries, stopped there being a massive recession as a result of COVID. You could easily have seen economies falling over because of COVID. We stopped that happen. When do you take the brakes off? How do you take the brakes off without causing untoward effects? It's easy to look backwards and say rates should have gone up earlier to choke off inflation. That's very easy to do. It's very difficult at the time to think of that. And having just gone through a period, the most extraordinary period, I guess, since the Second World War, when economies could have fallen over, you've got to give the central banks a bit of slack. I mean, it's just unheralded sort of times. And retrospect, I think they've negotiated it reasonably well. As I say, maybe they should have put rates up earlier to choke off inflation, but it's very easy for us to say that now.
Very good indeed. Thank you very much to my guest, Keith Hiscock, CEO of Hardman Co in London, for joining me. And Keith, hopefully you'll come back for another episode at some point soon.
I'd love to do that. Thank you very much.
Brilliant. And to the audience, please remember to rate our recent podcasts wherever you download your podcasts from, and look out for more episodes at IBKR Podcasts.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at ibkrpodcasts.com. And if you're interested in learning more about interactive brokers, visit ibkr.com. We offer more trading education material, such as webinars at ibkrwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at ibkrquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.